The average American household carries over $6,000 in credit card debt alone, but there's a mathematical strategy that could help you pay it off 73% faster than minimum payments. It's called the debt avalanche method, and most people are doing debt payoff completely wrong. Welcome back to Cashflow Kingdom, where we break down personal finance in a way that actually makes sense. I'm your host, and today we're diving deep into the debt avalanche method, the mathematically proven strategy for getting out of debt as quickly as possible. By the end of this video, you'll know exactly how to set up your own debt avalanche, calculate your savings, and avoid the biggest mistakes people make when trying to get debt-free. The debt avalanche method is surprisingly simple in concept but incredibly powerful in execution. Here's how it works. You list all your debts from highest interest rate to lowest, make minimum payments on everything, then throw every extra dollar at the highest interest rate debt first. Once that's gone, you move to the next highest rate, and so on. Think of it like an avalanche. You're attacking the most expensive debt at the top of the mountain first, then letting that momentum carry you down to crush the smaller debts below. The beauty is in the math. High-interest debt costs you the most money over time, so eliminating it first saves you the maximum amount in interest charges. This isn't about psychology or motivation, it's pure mathematical optimization. While other methods might feel better emotionally, the avalanche method will get you out of debt faster and cheaper than any other strategy, period. Let's talk about the elephant in the room, the debt snowball method that Dave Ramsey made famous. The snowball focuses on paying off smallest balances first for psychological wins. Now, I'm not here to bash the snowball. If it keeps you motivated, it's better than doing nothing. But let's look at real numbers. Say you have 3 debts, a $500 store card at 24% interest, a $3,000 credit card at 18%, and a $8,000 personal loan at 12%. Using the snowball, you'd pay off that $500 card first even though the $3,000 card is costing you more daily. With the avalanche method targeting the 24% rate first, you could save hundreds or even thousands in interest over the payoff period. The exact savings depend on your specific situation, but studies show the avalanche typically saves 10 to 30% more than the snowball. That's real money that stays in your pocket instead of going to credit card companies. Alright, let's get practical. Step 1 is creating your debt inventory, and this is where most people stumble because they're scared to face the reality. Grab every credit card statement, loan document, and bill you have. For each debt, you need 4 pieces of information: the creditor name, current balance, minimum monthly payment, and, most importantly, the annual percentage rate or APR. Don't just look at promotional rates that are about to expire, use the real, long-term interest rate. Once you have all this information, sort your debts from highest APR to lowest. This becomes your hit list, your debt avalanche priority order. Pro tip: if you have any debts with the same interest rate, put the smaller balance first since it'll clear faster and simplify your life. Also, make sure you're looking at the actual APR, not just the purchase rate. Some cards have different rates for purchases, cash advances, and balance transfers. If this debt elimination strategy is helping you see a path to financial freedom, hit that subscribe button and ring the bell for notifications. We drop new money tips every Tuesday to help you build your cashflow kingdom. This step separates the winners from the wishful thinkers. You need to figure out exactly how much extra you can throw at your debt each month beyond the minimums. Start by adding up all your minimum payments. This is your baseline that never changes. Next, do an honest budget audit. Look for subscription services you forgot about, dining out expenses you can temporarily cut, or side hustle income you can generate. Even an extra $50 per month makes a massive difference over time. If you can't find extra money in your budget, you have 2 choices: increase your income or decrease your expenses. This might mean picking up weekend gig work, selling stuff you don't need, or temporarily living a more frugal lifestyle. Remember, this isn't permanent. You're making short-term sacrifices for long-term financial freedom. The key word here is realistic. Don't commit to paying an extra $500 a month if you can only sustain $200. It's better to consistently pay an extra $200 than to burn out trying to do too much. Now comes the execution phase, and this is where discipline meets strategy. Every month, you're going to make the minimum payment on every single debt, no exceptions. Then, take that extra amount you calculated and add it entirely to the minimum payment of your highest interest rate debt. Let's say your highest rate debt has a $75 minimum payment and you found an extra $200 monthly. You're now paying $275 toward that debt while everything else gets minimums only. Here's the beautiful part: once that first debt is completely eliminated, you don't reduce your total debt payments. Instead, you take that entire $275 and add it to the minimum payment of your next highest interest rate debt. This creates an accelerating effect. Each eliminated debt makes the next one disappear even faster. Set up automatic payments if possible to remove temptation and ensure consistency. And please, for the love of your financial future, do not use the paid-off credit cards again while you're in debt elimination mode. Let me save you from the mistakes I see people make all the time. Mistake number 1: not accounting for promotional interest rates that are about to expire. If you have a 0% balance transfer that becomes 21% in 6 months, factor in that real rate when ordering your debts. Mistake number 2: getting emotional about balances instead of sticking to the math. Yes, it might feel good to pay off a $800 debt instead of chipping away at a $5,000 one, but if the $5,000 debt has a higher interest rate, you're literally choosing to pay more money for feelings. Mistake number 3: reducing total payments when a debt gets eliminated. The whole power of the Avalanche comes from maintaining the same total monthly payment amount as debts disappear. And the biggest mistake of all: continuing to use credit cards while trying to pay them off. You cannot fill a bucket that has holes in the bottom. If you're not ready to stop using credit cards completely during your debt elimination phase, then you're not ready to get out of debt. It's that simple. The debt avalanche method is mathematically superior, but it can be psychologically challenging because you might not see dramatic balance reductions early on. Here's how to stay motivated: track your total interest savings, not just balance reductions. Create a simple spreadsheet showing how much interest you're avoiding by using the Avalanche method. Those numbers will keep you fired up. Celebrate milestone moments like eliminating your first debt or reaching the halfway point on your highest interest balance. Consider finding an accountability partner who's also working on debt elimination, or join online communities focused on debt-free living. Visual progress trackers work great too, whether it's a thermometer drawing or a debt-free chart on your wall. Remember why you started this journey. Write down your why and read it whenever you're tempted to give up or make exceptions. Whether it's buying a house, starting a business, or just sleeping better at night, keep that vision front and center. The temporary sacrifice is setting you up for permanent financial peace. And there you have it, the complete debt avalanche method that could save you thousands in interest and get you debt-free faster than you thought possible. Remember, this isn't financial advice, just educational information to help you make informed decisions about your money. Your specific situation might require different strategies, so consider consulting with a financial professional if needed. Start by organizing your debts tonight, calculate your avalanche order, and take that first step toward financial freedom. Check out the description below for a free debt avalanche calculator template and links to budgeting tools that can help you find extra money for debt payments. What's your biggest debt challenge? Drop a comment and let me know. I read every single one and your question might become our next video topic. Until next Tuesday, keep building that cashflow kingdom.